shift gears and talk to kind of this whole FTX situation. And for people who aren't interested in crypto, I think it's still relevant to understand this, because as crypto has gotten to be larger in terms of market size, and so you might hear people talk about like market cap isn't necessarily the right way to describe it, but it's sort of like, what is the total valuation of all the cryptocurrencies out there? And as they got bigger and bigger and bigger, it becomes a larger part of the total kind of financial picture. And so its volatility can have spillover effects. And so that's why I think it's important to kind of understand what's going on here. So there's a bunch of different characters at play. The main one is this guy that they call SBF. His name is Sam Bankman-Fried. He is kind of the founder behind these companies. There's two major companies involved here. One is a company called Alameda Research that he founded back in 2017 as kind of his own quant trading fund. And one of the ways that he made money was he found there was an arbitrage. And an arbitrage is basically where there's a disconnect in asset prices that there shouldn't be. And so he basically found that if he bought crypto in the US markets, he could turn around and trade it in particular the Japanese markets. And because of lack of transparency, trading costs, things like that, he could make a spread on that trade. And so basically he did that over and over and over again, and started with like a few $1,000s and turned it into like $1 billion in a very short time period. And so that was kind of the start of this trading research firm. That firm is now run by somebody who's rumored to be his on and off girlfriend, this woman named Caroline Ellison. She's now the CEO of that company. Meanwhile, in 2019, they spun out a crypto exchange. So what is an exchange? It's basically like a marketplace, like the New York Stock Exchange, where people interested in buying and selling are brought together to execute on a trade. So you can think of, FTX as being that for cryptocurrency. However, there's not the same separation in the crypto world that there is in other asset classes. So for example, when you have a brokerage account and it's housed and custodied at Fidelity, right? That's who's holding on to your assets. When you make a trade, they're routing it through an exchange. FTX essentially was doing both of those things at the same place, right? They have custody of your assets, and they're also facilitating the trading. So you don't have kind of the same levels of checks and balances that you do in some other more established markets and asset classes, kind of the first thing to understand. But they spun out this crypto exchange back in 2019 over the course of a couple rounds of funding. So live Q&A a couple weeks ago, people asked about funding rounds. So as companies get more established, more investors get interested in kind of giving them money. And as of early 2022, like in January of 2022, they had their last round of kind of VC funding, and it valued the company at $32 billion. So it's not publicly traded yet, but well-known VC investors looked at the company and said, hey, we're willing to invest this much at this implied market cap, essentially is what that's saying. And the latest kind of published statistics on the company is that there were as many as 1 million users and about 300 employees at FTX. Now, the third element of this to understand is something called FTT, which is their exchange token. Essentially, like all of these cryptocurrency exchanges also essentially create their own cryptocurrency. And here's kind of red flag number one, is kind of why I'm not a big cryptocurrency fan. Is they all kind of pride themselves on that the value in cryptocurrency is that it's limited. It's not like the US dollar where the Fed can print as much as they want. However, anybody can just start their own cryptocurrency. And so from that perspective, there are very limited barriers to entry. And in some sense, there's unlimited supply because anybody could kind of come up with their own. But so all of these cryptocurrency exchanges, and I'll talk in a second kind of about who some of the others are, they all started creating their own tokens or own cryptocurrencies. And essentially they would sell them to users as a means for, they'd say, hey, if you hold our cryptocurrency, then you can trade on our platform at a discount. Or you get like you get special access or like first dibs on if some new thing comes to market kind of thing. It was a way to almost kind of like selling memberships. But they could also like hold some of the cryptocurrency, their unique one themselves. And as it traded on their platform and other platforms, it could be a source of wealth creation for them as well. Now, again, these are speculative, right? Like they're not based on necessarily the fundamentals of anything. It's just me being like, hey, I think someone's going to be willing to pay more for this in the future. And in some ways, the exchange token could be somewhat predicated on like the performance of the exchange itself. So as more people are interested and more people are using a specific platform, that could cause it to rise in value. But again, it's a speculative asset. So FTT was FTX's exchange token. And so let's see what else. All right, the other thing to know is that in 2022, FTX and their founder, SBF, Sam Bankman-Fried, we'll just call him SBF for short, were big spenders. He kind of talked this big talk about being frugal and living this frugal lifestyle and claimed like he slept at work and drove a Toyota Corolla. And he'd appear like at these major conferences sitting on stage with like former President Clinton and former Prime Minister Tony Blair, and they're like in suits and he's like in shorts and a t-shirt and sneakers. So he kind of portrayed this persona that was like frugal. However, over the last year, they were spending a whole lot of money. They bought the naming rights to the Miami Heat Stadium for over $100 million. They were buying and paying for production of Super Bowl ads. They also, as the value of crypto fell kind of across all different currencies, just like the value of the stock market has fallen this year, cryptocurrency is even more volatile. So Bitcoin, call it November of last year, was as high as nearly $70,000, and it's now come off substantially from that. That put other cryptocurrencies or crypto exchanges in distress, and so they were making acquisitions of these distressed exchanges over time. So that was going on. And then the other thing that has had a lot of attention paid to it is he personally, SBF personally, as well as his parents, which we'll get to in a second, he personally was the second largest donor to the Democratic Party for the midterm cycle, only behind George Soros. So he contributed nearly $40 million and had articulated promise that he planned to pledge up to $100 million or more for the elections coming up in 2024. And we'll get to kind of like why that matters in a second. So let's kind of review this timeline here. 2017, SBF founded his trading firm, which is still in existence even as in 2019, he spins off the cryptocurrency exchange piece of it. And he does that with a co-founder named Gary Wang, who's an ex-Google employee. In January of 2022, they kind of had their latest round of funding that valued the company at over $30 billion. The first kind of sign or public sign that there may be kind of issues at the company was back in July. This guy named Brett Harrison, who was an executive at FTX, tweeted that the funds are all stored in FDIC insured bank accounts and that everything has FDIC and SIPC insurance coverage. And and then also it starts to appear kind of in commentary about what FTX platform is, that they're this FDIC insured platform. Now, anybody who's been here a while, you've heard me talk about FDIC insurance before. That should raise a red flag to you because federal deposit insurance is something that was created by the federal government in the aftermath of the Great Depression, and it only insures bank accounts. It does not insure brokerage accounts. It does not insure stocks. It insures cash in bank accounts. And so very quickly in August, the FDIC sent a warning to FTX as well as a handful of some of these crypto trading platforms to stop making false statements and that the FDIC does not cover stocks or crypto or any brokerage accounts. So it was kind of a first indication of like, all right, here's a company that's growing really fast. And not only that, they seem to be playing kind of fast and loose with like compliance laws and regulations. And so, here's red flag number one kind of thing. So that was kind of over the summer. So then all of a sudden in the beginning of November, and this happened very, very quickly. On November 2nd, someone leaked, and they still don't know who, the balance sheet for Alameda Research, which is, remember, his trading company, the company that he's making trades in crypto himself. They linked the balance sheet for that company, and it showed that the asset side of their balance sheet was heavily dependent on FTT. Now, remember, FTT is their self-invented cryptocurrency. So how could that be a problem? Well, the problem is that it wasn't a super traded cryptocurrency. It's not like a Bitcoin, for example, that is kind of the most well-known, most actively traded cryptocurrency. And so because of that, when something doesn't trade a lot, the mark to market, or like what it's valued at on a marketable basis, is more easy to manipulate. So what was happening is they were essentially supporting their investments on this trading platform with this basically invented currency themselves that they could say it was worth whatever they wanted to say it was worth. And this linked balance sheet showed that they were far more dependent on that than like they had other liquid assets, for example. And oh, by the way, if you mark this to market, it really wasn't worth as much as they said it was worth. And so actually their liabilities were way bigger than the assets they had to support them. So that was kind of the first thing that happened. That was on November 2nd. On November 6th, Binance, so there's kind of like two major cryptocurrency exchanges out there. There's Coinbase and then there's Binance. Binance, and so the other thing to know too is that all these rival exchanges, they all hold like each other's exchange tokens. So you can kind of see how this starts to be a little bit like a house of cards. But so the rival Binance CEO says that he's liquidating all of his FTT holdings, so all of FTX's exchange tokens, because of this release that says there's some irregularity potentially at the company. And so he makes this big announcement, and that sort of creates what you could kind of liken it to a run on a bank. And so everybody comes to FTX, they want to liquidate their FTT position. And so the price of FTT collapses, which further exacerbates the issue at the trading company that is dependent on this FTT exchange token. And so I would kind of liken it, and you're hearing people in the media liken this situation to things like the Lehman collapse, things like the Enron collapse, and I'll kind of explain why they're making those analogies. So they're likening it to Lehman, and working at a hedge fund during the collapse of Lehman Brothers and Bear Stearns, what I will tell you is that when there are rumors that a company may be in distress, that there may be a liquidity situation, it sort of becomes like sharks smelling blood in the water. If you are worried that somebody who has custody, which means they hold your assets, if you're worried that they may become distressed, that they may not be able to make good on, or that in some way, like if they go bankrupt and it could lock everything up, you want your money out as quickly as possible. And like I vividly remember, like Lehman was one of our custody banks, and I think, I'm not going to remember the timeline exactly, but like I think they finally went bankrupt in September, and Bear Stearns was like earlier that summer. There were rumors of these issues, I would say as early as like the late winter, early spring. And so like we pulled our money out as soon as there was any concern, because you don't want to be caught with your assets stuck somewhere that you can't get them out. And what happens is that if a company is in distress and has some type of liquidity issue, and then people like go and all pull out their assets, it like exacerbates the issue, and it kind of becomes this vicious downward spiral. And so basically when the Binance CEO, who by the way is a competitor to FTX, says, hey, I smell an issue here, I'm selling out my position, and then everybody else follows suit, it kind of like is putting the nail in the coffin for the company. And so anyway, it causes the price of FTT to collapse as all these clients start making withdrawals, and it's kind of like having a run on the bank, essentially. So That was on November 8th. Also on November 8th, there's this announcement from FTX that they've agreed to be bought out or bailed out or acquired by Binance, who's this competitor. But very quickly, like within 24 hours, the Binance CEO says, nope, we took a look at the books, we're not interested. Which, by the way, just further seals the deal on like, there's something not right here. On November 10th, FTX suspends all boarding of new clients, so basically what's happened now is like, okay, we're not taking in any new assets, so they're not going to have any new money coming in. And they also, by the way, stop all withdrawals. So anybody who is trying to get their money out can't get their money out now. At the same time, on November 10th, FTX assets are frozen by Bahamian regulators. They're domiciled in the Bahamas. So that is kind of, at least as of now, the authority who's overseeing a lot of this. And then as of November 11th, FTX and Alameda Research officially filed for bankruptcy. So that's kind of like the official timeline of events. Now, what I will say is that there's a whole lot of like conspiracy theories, lots of like drawing connections about people who worked for the company and their former involvement with people like organizations like the SEC, like the CFTC, who are financial regulatory agencies that oversee various parts of the financial sector. But what I will say is that that's not hugely uncommon. And here's why, right? Like, crypto is this emerging asset class. It is rumored, as it's gotten bigger, that the government is going to crack down on it and start regulating it, because for it to really, and it's kind of a double-edged sword, like for it to get credibility, it needs to have trust, and it gets trust by allowing there to be more transparency and oversight, which is what government regulation brings. But government regulation can also bring additional costs. It can shut down some of the slush fund that's happening. So knowing that that's where this sector of the economy is headed, it's not hugely unusual or sketchy or anything like that they would want to hire former regulatory agents who are going to have insights into kind of that world. So there are people like drawing those connections and saying that those are red flags. I would say that that was probably smart in some regards, especially if you know that that's the direction this industry is ultimately headed. So here's what we've learned so far. That was what we learned kind of real time as all of this was going on. Here's some of the information that's come out since, as things have gotten locked down and like there's been more investigative reporting as to what went on. What we now know is that the trading company, Alameda Research, their balance sheet was largely built on the FTT token, basically the invented cryptocurrency from the exchange. And as the value of FTT fell, both along with the whole cryptocurrency market and then kind of on a more rapid basis, they had to borrow money to shore up their balance sheet. So other of their positions were losing. Think of it kind of like if you're investing on margin, or if your trading partners are going to want to know that you can support the positions that you're putting on, and they're going to want to look at your balance sheet, right? They're going to want to be able to validate that, like, hey, if you have this position and you're doing it on margin or borrowing some piece of it, as the position declines in value, they're going to ask you to put up more money. And so as these positions were losing, it was depleting the assets that they had. At the same time, a lot of the assets that they had were this FTT token, and it was getting marked down in value. And so they needed cash. They needed actual real cash, not fake cryptocurrency cash. And so they made loans from FTX customer accounts to the trading company. Now, AR and Alameda Research and FTX executives knew that FTX lent customer funds to help the trading company cover its losses and their liabilities, which, by the way, was a violation of their own terms of service. So this was definitively fraud. Like, what they did was illegal by their own company definitions. And so, there are going to be criminal charges in this situation. What they knew that what they were doing was wrong. They violated the agreement that they had to their customers, what they had promised their customers to do. And so there's definitely going to be fraud and criminal charges involved here. Now, the other thing to know that you'll hear people talking about is that SBF, the leader of all of this, his parents are actually law professors at Stanford. His mom is the leader of a major Democrat PAC called Mind the Gap, which is part of where like kind of his involvement in fundraising for the Democratic Party comes from. And his dad in particular is a specialist in tax compliance law, and was very active in the fundraising for FTX. Basically, like his parents gave him, kind of lent him their credibility. Like they're these very famous, well-established law professors at Stanford. And here's this guy who's setting up this, trading platform in what is the Wild West of cryptocurrency, but he's going to make it official. And he has these experts as parents who are experts in law and compliance. And they kind of like by association give him credibility, right? The other thing that happened over the, last call it year or so is that they partnered with celebrities to also give them kind of credibility from the outside. People like Kevin O'Leary from Shark Tank, people like Tom Brady and Giselle. What they would do with these celebrities is they'd say, hey, we'll give you an equity stake of 20 million if you will be our brand ambassador. So like Tom and Giselle recorded a Super Bowl commercial telling all their friends about the great FTX crypto trading platform. And so this is one of the things that I personally vet very carefully. Like you'll notice that I very rarely share branded content here. And when I do, it's something that I actually had a call with somebody last week and they couldn't answer all my questions. And they were the questions that if I were somebody going to use a financial product that I would want answered. And so that's what I told them. I said, look, I'm not going to present something to my followers that I haven't diligenced and vetted myself, because I personally bear that responsibility. At least that's how I look at it. So if you're loaning your brand and the trust that people have in you to a product, you should do some diligence to understand what's going on. And so there's a whole question around all of that here as well. As an influencer, what kind of responsibility do you have for the product that you're promoting? And by the way, do you need to disclose that, oh, by the way, I'm promoting this product and they gave me $20 million in equity. So if it goes well, I could stand to make, hundreds of millions of dollars, for example. The other thing that has come out about all of this is that allegedly SBF lived in a penthouse. So his whole frugal persona thing, lived in a penthouse with 10 roommates in the Bahamas. And the roommates included a bunch of FTX employees, including his co-founder and the director of engineering, as well as his on-again, off-again girlfriend, who is the CEO of his trading company. So there's this whole romantic incestuous thing going on. The whole thing kind of sounds like, okay, you have a frat house running this multi-billion-dollar platform, and then when they run out of money, they're playing fast and loose with all the rules. So anyway, that's the best of what I can make of it so far. And all of this obviously just shines a really bright light on the fact that I think the fallout from all of this is that it's just continuing to push and up the cries for crypto to be more regulated. So that's what I got for you. I don't know if there are more questions or if that addressed a lot of the questions about kind of crypto in general, about kind of what went on with this specific situation. I saw, I think, a few comments along the way. Somebody saying this is so helpful. Thank you for explaining so well. I will say that even as somebody that knows finance and financial markets well, this isn't easy to understand. So if all of this sounds like complete Greek to you, somebody's saying FTX, wow. I watched the Enron documentary recently. It's unbelievable scammer. So the other comparison that people are making to this is Enron with the whole, so Enron back then obviously didn't have crypto, but they kind of did something similar with shell companies. They would basically house underperforming power assets in shell subsidiaries that they could then trade amongst themselves and market to market at whatever they wanted. And so they were basically writing up assets on their books at a far higher valuation than what they were really worth, which then allowed them to do even more than they would have been able to if they had had to write them down. And so that's kind of the analogy with like FTT and the FTT crypto mark, that by not marking it down to where it was really worth, it allowed them to kind of hide their distress for longer. I think it'll be very interesting to find out like who finally leaked the balance sheet. I don't have any insight into that specifically, but my best guess is that it has to be either somebody on the inside or a trading partner, some sort of like partner that is, concerned about their position. Because in a space like this, like there are only so many people that you can trade with of size. And so their counterparties will have some insight into knowing like, okay, we know you put this position on with us. We know that this is where it's been marked down to. Like, we're not going to trade with you anymore unless you can show us that, like, you're liquid and that you can support these positions. So that's my guess, is that it came from somewhere like that. But we'll, I'm sure, find out far more likely in the coming months, years. And, it's one of those scenarios where people, yes, are already talking about kind of like who would play them in a movie. Somebody's saying, is it legal common for agencies to stop clients' abilities to withdraw their funds? One, it is not common. Two, is it legal? So this is a good question. So let me give you kind of an example of times this has happened before. So one, we knew it happened with Robinhood, whenever that was, like back at like during the pandemic, where they kind of like stopped withdrawals for a minute. It often happens around kind of liquidity concerns. Back during the Great Depression, actually, the US government closed all US banks to stop runs on the bank in order to restore faith in the kind of financial community. And the federal government went through and made sure that they only let banks reopen that they validated had, stable balance sheets. There's an element of human psychology to this. And so one of the mentalities is, okay, if we just press pause for a second and let everybody catch their breath, then maybe calmer minds will prevail and we can sort this out and everybody loses less money, is sort of the mentality. The legal ability would kind of depend on how their customer agreements are written and things like that. But they were doing so many things that were in violation of their own terms of service already. Who the heck knows? But that is why when I say things like, choose a broker, somebody who's going to hold on to your assets and have custody. When I say custody, I mean like that's where they're held, right? Like when you have a brokerage account, you aren't physically holding the cash in your house. It's domiciled at a bank somewhere or at a brokerage somewhere. Registered broker dealers, when I say registered, that means they're registered with a regulatory agency. They have rules that they have to follow. They have to, they can be investigated by people like the SEC or by FINRA for violating those rules, and they could be shut down. Nothing exists like that right now for crypto, which is why you have to be even more careful. There's no kind of laws, regulations, oversight looking out to protect the consumer in the world of crypto. And they would argue, they being like crypto fans, there's kind of this element of it that is DeFi or, democratizing finance, that it doesn't need any of that oversight because it's all self-regulated. Well, this is what that self-regulation is looking like. So anyway, I'm way over the 30-minute mark, but I hope that for those of you who are interested in understanding this, that helps make sense of some of it. There's a lot of scandal always fuels kind of like the salacious headlines and things like that, but I tried to stick to like the financial factual elements of it, but we'll of course probably be learning more as time goes on.